Let's consider that the market suddenly makes a large movement in one direction. Perhaps this movement is in response to new information coming into the market, or it can simply be a result of a random price spike. No matter the reason behind the price fluctuation, this type of sharp movement is called a momentum move. This means that the market accelerated. As the price movement starts to slow down, the momentum will also slow down. Now, wouldn't it be ideal if you entered when the market momentum was increasing? Of course, when you have momentum on your side, trading becomes easy. When you enter during a lack of momentum, your trade will stagnate, or even worse, you will get chopped out by the lateral price movement. That's why today we'll talk about momentum indicator, and you'll learn how to take signals in order to synchronize with the market when it's ready to make a significant move. Also, make sure you subscribe, click the bell icon so you don't miss our future uploads, and leave us a like to show your support. Momentum indicator is an oscillator which identifies the strength or speed of a price movement. The momentum indicator compares the most recent price to a previously determined price and measures the velocity of the price change. So basically it's the difference between the most recent price and the closing price of a previously determined period. The faster the price increases, the bigger the increase in the momentum indicator. The faster the price decreases, the bigger the decrease in the momentum indicator. The most used settings for the momentum indicator are 7, 14 and 21. Momentum settings with values over 21 make the indicator less sensitive. This will result in fewer but better quality signals and a smoother line of the indicator. Momentum settings with values below 10 make the indicator oversensitive. This will result in more market noise. Lower settings on the momentum indicator should be carefully traded, as it can lead to many false signals. Here is how you should read the momentum indicator when you analyze the trend. If the momentum indicator is above the 0 level, this signals that the market bias is on the upside. If the momentum indicator is above 0 and the market price is increasing, this signals that the trend is accelerating. This implies that the current upward trend is strong and likely to continue. If the momentum indicator starts declining but is still above the 0 level, this means that the trend is still on the upside, but at a reduced rate. This signals that the market is losing upward momentum. This doesn't mean that a reversal or trend change will happen. It's just a warning sign that the momentum is getting weaker. If the momentum indicator is below 0, this signals that the market bias is on the downside. If the momentum indicator is below 0 and the market price is decreasing, this signals that the downtrend is accelerating. This means that the current downtrend is strong and likely to continue. If the momentum starts increasing, but is still below the 0 level, this means that the trend is on the downside, but at a reduced rate, and signals that the market is losing downward momentum. As in the case of an uptrend, this doesn't mean that a reversal or a trend change will happen. Now let's see how to trade with the momentum indicator. One of the most common ways in which traders use the momentum, but not a smart way, is to take signals when the oscillator crosses the 0 level. So when the momentum indicator crosses above 0, a buy signal is generated, and when the momentum crosses below 0, a sell signal is generated. If we analyze this Tesla chart, we might get fooled by the last two valid signals generated by the momentum indicator. As most indicators during trending conditions, the indicator will offer good signals. But what about when the markets are not trending? Look at this area. You can see at least 4 or 5 false signals which would have damaged your account. Despite the fact we are analyzing the daily chart, we can clearly see that the indicator is not reliable for generating good signals when used alone. So you should never use the momentum as a standalone tool. Pay attention to key levels, identify the major areas of support or resistance, and use momentum as an additional confirmation instrument to confirm your bias. Now let's look at the same chart once again. Let's plot the support and resistance lines, identify the trend using price action, and let's see what the momentum is telling. So we are on a clear downtrend, with the price making lower lows and lower highs. This tells me to ignore when the momentum crosses the zero line to the upside and focus only on the short trades. Now let's plot major support and resistance lines. Here is the most important trade, our entry point. We have a breakout of a key support line, with a retest of the breakout level, and the momentum staying below zero line. A short trade around this area was a high probability trade, because we had price action and momentum indicating the same thing. Momentum oscillator can also detect divergences. A divergence occurs when a price action is different from the evolution of the momentum oscillator. This basically means that the momentum isn't reflected in the price, which could be an early indication of a reversal. As in the case of stochastics or RSI oscillators, when a divergence occurs, a potential change in price direction could be on the cards. This is how I spot divergences with the momentum indicator. I like to determine the main trend by adding a 200 period exponential moving average. When the price trades above the 200 EMA, I consider taking only long entries, and when the price trades below the 200 EMA, I enter only short trades. I search for divergences between the momentum and the price only in the direction of the main trend, indicated by the 200 exponential moving average. So if the price trades above the 200 EMA, I search for divergences on the lower side of the momentum, and if the price trades below the 200 EMA, I search for divergences on the upper side of the momentum indicator. I enter when I spot a divergence in the direction of the trend, when the momentum crosses below or above the zero line. Also, if you aren't familiar with divergences, I recommend you to watch this video after you finish this one. Let's use the same Tesla stock, this time on the hourly time frame. We added the 200 EMA, the price is below it, lower lows and lower highs, so a clear downtrend. We search for divergences on the upper side of the momentum. Here is the first divergence, the price making higher highs and the momentum indicating lower highs. You enter short when the momentum crosses below zero line. Here's a hidden divergence. The price is making lower highs, but the momentum shows higher highs. You enter when the momentum crosses the zero line. You see how important this rule is. You cannot enter just because you see a divergence. The price could increase even more. By waiting for the zero line cross, you have a protection buffer and enter only if the downward momentum is strong. Also, I know you will be tempted to take regular divergences on the lower side of the momentum. I noticed this divergence here, and yes, it was a good divergence trade, and another one here, with a potential entry here, a perfect trade, almost catching the market bottom. However, I trained myself to ignore the signals that aren't in line with the main trend. I lost a lot of money entering counter-trend positions, and this technique will save you a lot of bad entries, which at the end of the day are contrary to the primary trend. I want to ride the main trend, and all the setups that occur in the opposite direction will be ignored. In order to smooth the signals offered by the momentum, many traders prefer to add a moving average on it, like in the case of the RSI to take crossover signals. Now, when you want to trade a crossover between the momentum and the moving average, you should be aware that a crossover will be effective when the markets are trending. When markets are trending in a range, this system will not work. This problem can be diminished by once again responding only to signals in the trending direction. In this case, if the trend is up, make a long trade only after the indicator has moved above the moving average. I still prefer the zero line cross in combination with price action, but you could test different moving average periods and momentum indicator settings to find the combination that works for your trading style. If you found value or learned something new, don't forget to subscribe, click the notification icon and leave a like to show your support. Until next time.